Berkshire Hathaway put out their annual 2022 shareholders letter last week, and it was very different. It was a very different tone than I'm used to seeing. Now, I have read the Berkshire letters from the 60s through present day. I've hit them all, and I recommend that you do that because it's very interesting to see. We have something very special in our lives. We have Warren Buffett and Charlie Munger, not just what we see from them day to day, but we have a written track record of them all throughout their unbelievable career. Buffett actually said in his letter that he's been investing for 80 years. That's basically a third of the time that the United States has been around. It's absolutely unbelievable what type of information that we have that we can chronologically put in order and see one of the greatest, if not the greatest investor of all time. So we're going to look at what I pulled out of the letter, my favorite things that I found about it, little gems here and there, both from him and Charlie. Then we're going to break down the stock. So let's start with the letter. And if you guys are looking for this, all you need to do is Google Berkshire Hathaway 2022 Annual Shareholders Letter. It's going to take you right to their website. You can download it and read exactly what I'm going through right now. So usually what he'll do is different. He usually says Berkshire Hathaway beat the market or lost to the market by X% each year. That's usually how they always started. Didn't start that way this year, but he's been doing that for a little bit of time. So he goes through and he talks about his role in the company, Charlie's role in the company, what they do, what their goals are. Now, the first thing that I noticed that I really liked about this, and this is something that separates value investors from other people that are not value investors. Charlie and I are not stock pickers. We are business pickers. And we've said it so many times on this show. When you buy a company, you are buying a piece of a business. And I say this one all the time because Apple is my favorite company out there. When I'm buying a share of Apple, I am buying the exact same thing that Warren, Charlie, Tim Cook, Steve Jobs, etc., whoever they are, we are buying the exact same thing. And once you realize that, it's going to change the way that you look at investing. You're not just buying a ticker symbol that's worth $150 at that moment in time. Now, it's crucial to understand that stocks often trade at truly foolish prices, both high and low. The efficient market theory only works in textbooks. And this is something that we have been seeing in the media over and over again about efficient market theory. The stock market is a voting machine in the short term and a weighing machine in the long term. Your stocks are going to hit the values eventually. It just depends on where market sentiment is going at that moment in time. In truth, marketable stocks and bonds are baffling. Their behavior is usually understandable in retrospect, and you can look back just as short as 2020 and look and say, oh, well, I could have done this, I should have done this, this is why this happened, etc. Now, something that I found very, very interesting. Our satisfactory results, he means over the entire term of his tenure at Berkshire Hathaway, have been produced by truly a dozen of good decisions that would be one every 5 years. So this goes back to the theory of if you're buying a basket of stocks, say you're buying 30 stocks, 5 of them, 3 of them, whatever, are going to do very well. We'll give those plus plus. The majority of them, they're just kind of sit in the middle. Actually, we'll give them plus minus. And then some of them are going to do very poorly. We'll give them minus minus. But these are the ones that are going to pull up your portfolio. And your average ones are going to keep you right at bay kind of with the market. These could give you a little pull down some years, but over a long period of time, that's why buying a basket of stocks, similar to the little book that beats the market, or buying the S&P, but more so the little book that beats the market, that's why you're going to be beating the market, because you're going to have those big ones pull you up. Your majority of them are going to sit right in the middle, and you might have some that beat you down a little bit, but he's saying that truly a couple of dozen good decisions over the 50-some years at Berkshire Hathaway. Now, let's keep going down. He goes through their earnings here that we'll touch on in a moment. At Berkshire, now this was a big topic of conversation. This was the share repurchasing. So we have seen from the White House that share repurchases, stock buybacks, whatever you want to call them, are going to be wanting to be taxed at some type of 4% rate. So they're going to tax corporations. Now, he actually gets into a little bit here, which I was incredibly surprised about because he's usually pretty diplomatic and doesn't really, it's more of Charlie to go on the attack. But At Berkshire, we directly increase your share of a unique collection of businesses by repurchasing 1.2% of the company's outstanding shares. Now, that's of Berkshire stock alone. Apple and American Express repurchased their own shares, so without Berkshire having to do anything, that helped their shareholders directly. The math isn't complicated. And I pulled this out, and I know this is a lot to highlight in a video, but I wanted to pull this out because it's something that we say all the time. When you're looking at these hype type stocks and they are diluting the heck out of you, it's not the best place to be as an investor. But companies also buying back shares at expensive prices are also doing a disservice to you. So let's look at this. The math isn't complicated. When the share count goes down, your interest goes up. You're owning more of the company. Every small bit helps if repurchases are made at value accretive prices, good prices. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow to the selling shareholders and to the friendly, and then yada yada. This is the point. The point is, you cannot buy back stocks at expensive prices. You have to buy them back at good prices. Now, here's where I was surprised. When you are told that all repurchases are harmful to shareholders or to the country, or particularly benefit CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. That is not something that Warren Buffett usually says, so he must feel pretty passionate about this topic. Now let's continue. At year-end 2022, the biggest holdings of Berkshire were American Express, Bank of America, Chevron, Coca-Cola, HPQ, Moody's, Occidental Petroleum, and Paramount Global, one that I don't understand. Getting into the taxes now, another thing this is why this letter was a little bit different for me, because Buffett doesn't usually say this stuff. During the decade of ending in 2021, the U.S. Treasury received $32.3 trillion while spending $43.9 trillion. Through economists, politicians, and many public, the opinions about the consequence of the huge imbalance, Charlie and I plead ignorance, and what they do is they don't try to predict which way economic forecasts are going. They just try to buy good businesses at good prices. Actually, good businesses at great prices. Now he goes in to talk about how he's never seen a time where the future of America is weak, etc. Now he gets into some Charlie quotes, and you guys know I love Charlie Munger. I actually have a big bronze bust of him that I got from Manish Pabrai in my office at home. So I'm going to go through some Charlie quotes. The world is full of foolish gamblers, and they will not do as well as patient investors, you and me. If you don't care whether you're rational or not, you won't work on it. Then you will stay irrational and you will get lousy results, and that's what we're seeing from a lot of people that started getting into markets in 2020. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a very long time is a huge advantage. You can learn a lot from dead people. He said this many, many times. Read about the deceased and listen to what they say. A company keeps working after you are not. A great company keeps working after you are not. A mediocre won't do that. That's when Paul always comes back and he says, if the CEO dies tomorrow, the business doesn't move on, then there's no business. It's a job, it's a hobby, it's whatever. It's something that generates cash and maybe generates cash. And if you die, it's over. That's not really a business. And let's see. I will add to Charlie's list a rule of my own. Find a very smart, high-grade partner, preferably slightly older than you, and listen to what they say very carefully. And that's what you have there. So that is my summation of the letter. I loved this year's letter. I thought it was different than every other letter. But now let's get into the stock. And I'm about to use this software behind us. Guys, we have done probably 2,100 plus videos right now. And a lot of them go through our software. I implore you, watch 4 or 5 videos. It'll change your view on investing. We are very similar to the Buffett Munger type way of investing. Manish Pabrai, who is one of Charlie's closest friends. I'm going to go through this software. We are offering a trial right now, $7 for 7 days. You're going to get everything that I'm about to show you here, plus you get the Everything Money community. There's thousands and thousands of people with the same type of thinking as you. And the great thing is, also different types of thinking. So you can have these conversations, go back and forth. I was talking with somebody on there this weekend. We were going completely back and forth. We completely disagreed on something. But you know what? That's what the community is for. It's not to all be mind-numb robots and just think all the same. It's to have those conversations and make people think. So looking at Berkshire, a lot of questions come about this. Should I just buy Berkshire instead of buying the S&P? Well, actually, if you would have bought Berkshire instead of the S&P over the past 5 years or something, the S&P actually beat Berkshire. But we're not looking at 5 years. We're looking over a very long period of time. And if you like what Berkshire does, they own a lot of privately held businesses, a lot of insurance, then a lot of stocks. Then that's maybe for you. They own a lot of banks. They do so many different things. So let's go through this and see what we would pay for Berkshire. I don't think there's a right or wrong answer here. Now, looking at this one, market cap to enterprise value. We usually say, hey, that's a little bit much because there's debt. The net debt is the difference between the two. Now, why is it so big in here? Because Berkshire is so involved in insurance. That is the reason. So, and they have a lot of banks in their portfolio, Bank of America, et cetera. So that's going to skew things a little bit, and that's kind of why you can't look at this and say, oh, right off the bat, no, we can't do that. Net income down. Let's actually get into the income statement a little bit. But remember, it's kind of hard to look at this and say, yeah, this is really good, this is really bad, because it is such an incredible amount of holdings that they have, both private and public. Now, looking at their revenue over the past, call it decade, it's been increasing. 2021 was a banner year, and now it's coming back to normal, and I think that normal is probably in this range. So I am okay with this, even though it's decreasing a little bit. I think that they're going to sustain around these levels instead of having this huge jump to 279 billion, 350 billion basically, and then back to 250 billion. Doesn't scare me. Doesn't completely scare me because coming off COVID, big numbers, etc. Let's look at net income. Now, net income, I have to figure out what is going on right here. I'm wondering if there were some type of write-downs, disposition, some acquisitions. Let's go cash flow and see if we can find anything. No, not really. So I would go and actually dig into that a little bit more. Now let's see what analysts have to say about this company. I'm sure there's a lot of analysts that are not. Okay, different. But looking out 2 years, end of 2024, 6 analysts. It's looking at, there's revenue growth, but it's almost normalized. You know what? Okay, let's go to Stock Analyzer and throw some numbers in here. So revenue growth over the past, let's go with 3, 5, and 7. Profit margin. Profit margin is a little bit skewed right now. So let's go with 10, 12, and 14. I know 14 is high, but let's see what happens when we put this in. Let's go 6, 8, and 10. PE, 14, 16, and 18. 14, 16, and 18. And for my return, I'm going to go 10, 12, and 14%. So guys, this is going to spit out 6 numbers. This doesn't mean go buy, go sell, go do whatever. This means let's see what kind of range we're in. There's a lot of things that I just pointed out in the income statement and the cash flow statement that you need to go figure out before buying into this thing. Now let's see. So right now, we're sitting at about $304 a share. I'm looking anywhere between 100 and 165 to a high end of 192 to 270 with a middle ground of 215 to 140. These numbers are all over the place, and it really depends on the research that you do. I put in a wide range of numbers right here. Wide range. I think there's a better way for you to condense these down when you start going through. That's what I got out of 2022 from Berkshire Hathaway. You guys have a great day.